going to show you one of the neatest ways to invest in the options world, and that is to use debit spread, and in particular in the money debit spreads, for both call spreads and put spreads based on what direction you think the market's going to go. And the 521X trading system will help you pinpoint exactly what the likely moves are going to be on a short-term basis. And so we'll use a front month spread option. And if you're unfamiliar with debit spreads or spreads in general, basically you're buying one strike price and selling another strike price at the same time. And if you collect money in that event, it's a credit spread that they credit the money to your account. If you pay money for that position and it costs you something, then it's what we call a debit spread. And I always recommend you use debit spreads because credit spreads require a lot of adjusting, and in iron condors and whatnot they're always used, and a lot of people like them. I don't, because the risk to reward ratio is just not that good. But if you're unfamiliar with spreads, I want to show you just how neat they can be. Here, let's look at SPY, and the SPY is trading, I think, currently at 118.08. And I've got instructional videos on how to use these calculators, in particular when you purchase the system and whatnot, so I won't get into that here. I just want to plug in some numbers so you can see how this might work. So if this is where it's trading now, what you can do is you can go to your brokerage account, or you can go to a place like Yahoo Finance and just type in whatever the security is. And on the left side is a selection you can click on to get the option pricing. And so right now it's trading, these are the options, and this is the last that these strike price have traded at. So let's just look at a couple of these. Let's look at the 114 strike, and we want to buy deeper in the money than the one we want to sell. And if it's trading at 118, that's at the money. So we're going to look back here. Let's plug in, for argument's sake, 114 strike. That would cost us 401. So we come in here and we tell it we buy the 114, and it'll cost us $4.01 per contract. Now we got to decide which one to sell. Well, I just know I'll go $1 out. So let's say I'm going to sell the 115, and when I come back to my option chain, I'm going to collect 324 if I sell that one. And this is how you tell your brokerage company to do it. I'm going to buy this one and sell this one, and I want it, my limit price is going to be 77 cents. So in other words, I'm going to pay 77 cents, but at option expiration, as long as it's above $1.15, I'm going to have that spread back out to the full dollar difference, and that's why we call it a spread. And here's how the numbers work. Let's say that SPY doesn't go up, doesn't go down, it stays right at 118 within the next 3 weeks, 4 weeks, by the time November 19th rolls around. Let's say that it stays right at 0% change. It's still trading 118. I make 29.87% on my return, on my investment, anything I put in there. That is pretty cool. If it goes up and I'm right, I'll make my 29.87. Let's just call it 30%. If it goes up 10%, I'm making 30%. So it's had a huge 10% move, and I'm still tripling what that move would have been if I just bought the underlying outright. If it goes up 15%, I'm going to get my 30%. Now here's where it really gets pretty cool. And that is, let's say that I'm wrong. Let's say that it retraces and SPY does not go up when I get my signal, and I think it should. In fact, it drops 2.5%. If it drops 2.5% and it goes from being worth 118 down to only 115.13, I still make almost 30% on the trade. And the reason I do is because over time, over the next 3 or 4 weeks, the extrinsic value will erode out of the options, and since I'm a seller of these options, I get to take advantage of that. I've taken advantage of and built in a discount to where I can get a position on at a discount. It's costing me 77 cents when the thing will spread out to the full dollar.